of all, thank you for joining us today. This webinar on Insurtech and insurance, reevaluating risk. And first of all, I'd like to thank you all of you and all the great speakers that will be with us today. My name is Suzy Reitan, and I'm the Senior Trade Officer who's leading activities in cybersecurity, fintech, and of course, insurance and Insurtech at the Israel Trade and Economic Mission in London. Before kicking off officially, I would just like to have Yariv, our attaché, say a few words before he goes back to his packing, and we will then kick off.
Thank you very much, Suzy. First of all, I apologize for the casual appearance. I'm really in the middle of packing our apartment where I'm finishing my post here in London in a few days, and we're moving out of our flat today. So it's a great opportunity. I think one of the last events that we're doing, and I'm very thrilled and excited about it. We have great speakers today. I think a very timely and important topic to touch on, which is very relevant to London, to the insurance industry, and of course, I think Israel plays an important part in this space. I want to thank all the speakers that took time to join us today and share their insights and thoughts, and of course to all the attendees that are attending today and listening in. And many thanks to Suzy who has put this together while being in 2 different countries in the meantime. Thank you very much. I look forward to listening in. Just to make sure that you guys don't see any packages going back and forth, I'm going to close off my camera. So thank you very much, and good luck today.
Thank you, Yariv, and good luck. First of all, let's just slightly focus more on what we are about to discuss today. So we've gathered, I would say, really amazing speakers that come from the insurance industry, from the regulators, from different areas of technology and the startup ecosystem, specifically in Israel, because we would like to speak more about how the insurance market might prepare and get ready to face more and in a better way, also like extreme risks that are threatening and the continuity of small and large businesses. And more specifically, we will also focus on some future opportunities and insights when it comes to risk management and assessment of such extreme scenarios. And that's why we have gathered such great speakers to share both their perspectives and insight and debate about what could be a new way forward. So we will have specifically on the panel Amit Gal, who's joined us today. Thank you, Amit. He's the Senior Deputy Commissioner for Solvency and Risk Management at the Israel Commission of Capital Markets, Saving and Insurance Authority. Emma Watkins instead will join us from London as Head of Exposure Management and Risk Aggregation from Lloyd's. Ala Gil, speaking from New York, will instead speak as the CEO and founder of Straterix, and last but not least, Arion Cohen, Director of Sales of Exigence, will as well contribute to this conversation from his perspective. So again, last but not least, I'd like to introduce Otni Oron, our moderator from today, as well as the FinTech Manager for the UK Israel Tech Hub. A few words about him before giving the stage to him directly. So Otni is in recent years has worked with hundreds of Israeli startups and dozens of banks and insurance companies from more than 30 countries and 5 continents, with major focus on the UK, of course. And as such, Otni holds a unique understanding of the scope and depth that the Israeli fintech scene holds and the emerging trends, and both global and UK specifically have within the fintech and Insurtech scene. So without taking more time than what I've already taken, I'd like to thank everybody again for joining us, and I really hope you will enjoy this conversation. Omid, the floor is yours.
Thank you very much, Susie, and everyone, of course. I'll start with a few words about the UK Tech Hub, and from that, we'll continue on to our great panel. So just in a few words, the UK Israel Tech Hub is a mission within the UK Embassy in Tel Aviv. We're assigned by the British government to help UK businesses, essentially providing them with necessary knowledge and access to Israeli high-tech in general. We focus on specific domains, fintech, insurtech, obviously, otherwise we wouldn't be here. Health tech, smart cities, edtech, quite a few, and also some societal initiatives like Women in Tech, Arab sector, and quite a few of those, very, very interesting. We frequently work with a wide variety of organizations, including tier 1 banks and insurance companies, obviously more organizations which are more sector specific. And that's pretty much it for now. And now really with no further ado, let's get to know our amazing speaker for today. Let's start with a quick 1-minute intro round. Emma, would you like to start, please?
Apologies, let me unmute myself. I'm Emma Watkins. I work in exposure management at Lloyd's, overseeing catastrophe risk for at the level of syndicates in the Lloyd's market and for the market as a whole. I've got a background in exposure management and underwriting.
Fantastic. Amit?
Yeah, thank you. So I'm Amit Gal. I'm serving as a Senior Deputy Commissioner in the Insurance and Capital Markets Authority in Israel for the past 1 year more or less. I'm in charge of Solvency II local regime, the risk management framework, reinsurance, and cyber risks within the supervised entities. Formerly, I was within the industry, within a local big company, and before that with Standard & Poor's, the local branch. So that's more or less it.
Great. Ala?
Hi, I'm Ala Gil. My background is in mathematics, optimization, and I was working in investment banking for many years, covering pretty much all insurance companies around the globe, in UK, in Israel, and everywhere else, and not just insurance companies. Straterix is the software company where we build the software product that can help to address exactly the issues like COVID.
Wonderful. Arion?
Hi, thank you for having me. I'm Arion Cohen. I'm with Exigence, and at our company we address major incidents, the ones that present major risks, the ones that affect organizations' revenues, productivity, and customer retention. And we have developed a virtual situation room software, which when an incident occurs can quickly bring in the right team, provide this team clear visibility into the incident, and provide it the tools to resolve the incident, driving down resolution time. So I'm the director of sales. In the past, I've also sold security software for a long time in many different geographies, and maybe this is another angle from which I can contribute to the discussion.
Great. So definitely it's a great opportunity for me to exercise being the least smart guy in the Zoom. So just to lay the groundwork, okay, for the entire discussion. Emma, maybe you can share with us what's Lloyd's view or approach on large-scale systemic risk, like some of the basic concepts, basic ideas, how to tackle such big problems. I'm starting, you know, small.
It's a big question. Yes, so large-scale catastrophic events are, are reflected in a number of the key milestones in the evolution of the Lloyd's market, and they're one of the things that Lloyd's is known for. As an example, the 1906 San Francisco earthquake highlighted our reputation for paying claims, and also highlighted the fact that you could place insurance overseas and it still would pay out when it was required to. That event also led to this recognition that large single individual claims, as well as large numbers of smaller claims that result from a single catastrophic event, could threaten the financial continuity and the livelihoods of insurers. And this really led to some great advances in risk management and in the development of various tools such as reinsurance for protecting profits and solvency. Towards the end of the 20th century, there were a number more great catastrophes with large aggregations of losses that impacted the Lloyd's market. And so we introduced what we call realistic disaster scenarios, or RDSs, to the market. And that's and they were and continue to be a key way in which we evaluate the potential impact of large-scale losses on the market and on individual syndicates within the market. They are high severity, very extreme loss scenarios, but they have low but not zero probability of actually happening, hence realistic. Such as a Cat 5 hurricane hitting Miami, or another earthquake in San Francisco. We also have RDSs for different perils, such as a marine collision of two large ships, and things like that. So it's not only natural catastrophes that we look at. The key, I think, to this conversation is systemic risk is something that we see as a little bit different, or at least it's a little bit more extreme and mostly less well understood. With systemic risk, we're talking about the breakdown of an entire system rather than simply the failure of individual parts. We're talking about events that cross what insurers normally see as their portfolio boundaries, hit more than one line of business. And we're talking about often cascading failures that are caused by the linkages within a system. So what we get are severe and quite often unforeseen impacts. The global financial crisis of the late 2000s is an example. Pandemic is also clearly an example. Others could be a global cyber attack, a massive failure in power generation or distribution, or significant disruption in supply chains, which is key at the moment and can be caused in many different ways, such as through a pandemic, or a single impact or a single event at a single port could hit a supply chain and reverberate around the globe. The problem with these kinds of risks is that we're not as far along in our efforts to understand them and model them as we are with our sort of more typical single, easy to understand nat cat events, and this makes it really.
I'm just thinking of the people who are developing those RDSs.
Yeah.
Seeing a lot of horror movies and kind of come up with all the potential scenarios.
We spend a lot of time thinking about what could go wrong, and just how bad things could get, which is a bit depressing, but. It's very important that we try to understand, how much exposure we have to these things, because they have the ability potentially to bankrupt the industry, if not entire countries. What we have to do is try to keep progressing in our understanding of them. So, not long ago, flood and earthquake were often viewed as uninsurable because we couldn't predict them, we couldn't model them, we didn't know how to price for them, we didn't know how bad they could be. But now we have great sophisticated models, which means we can analyze those perils and start to insure them more widely. So Lloyd's is doing a lot of work at the moment on systemic risk to find ways in which we can understand it better. We can break systemic risks down into their individual parts, so we can analyze them more easily. And technology gives us the ability to model things like supply chains, things that previously we thought were much too complex. We can now model supply chains, and we published a paper on that last year.
I'm going to kind of just stop you for a second. It's really interesting. What I will do, I'm going to kind of refer another question to Ala, which kind of indirectly going to refer to what you just talked about, and maybe together then we can tackle from a direction. So definitely going to readdress it in a few minutes. Ala, kind of adding on kind of the basic of what Emma just talked about. You know the kind of the risk management world in and out. Anything you think maybe change or kind of reevaluate in order to adjust itself for the next extreme scenario? Emma talked about a little bit, how do they start tackling? I kind of stopped there in the middle, but how do you see it? Maybe how do you see the future of it? And then we can kind of combine it with Emma's answer.
Yeah, so first, I think what Emma touched on is very important, how new technologies, new data enables insurance industry to analyze the next, critical events, crazy events. And also how every time a new occurrence gets insurance industry prepared for the next one. So obviously, pandemic, the COVID-style pandemic never happened before. We had Spanish flu 100 years ago, but the economy didn't shut down because of that. This great shutdown of the economy is totally unprecedented.
Yeah, there's some disadvantages of being a global village, I guess.
I guess so, exactly, right? And, the countries are learning from each other's experience. But we had pandemic scares so many times in the past 20 years, at least 4 or 5. So at least we could get some idea what pandemic, at least, approximately might have looked like. So definitely pandemic shock, even though pandemic didn't happen prior to this year, pandemic shock should have been incorporated in many insurance companies' considerations. Even if they don't insure directly against pandemic, they insure against a lot of other things that are connected with pandemic.
Yeah, that's definitely related to the RDSs that Emma talked about.
Exactly, and I think what Emma also pointed out, what people are missing right now is consequences of an initial shock. What kind of propagation it might have further down the line, a snowball effect, right? And what it can impact. And by the way, it's very important to consider not just the liability side, not just how many claims you will have to pay and how premiums you will be able to write, but also on the asset side, asset liability management, etc. And so just speaking about where risk management needs to go now. Risk management, exactly like insurance industry, learns from its mistakes, right? The crisis of we had value at risk as risk management in the 90s, right? The crisis of 98 got us Basel II and economic capital. And then insurance crisis in Europe in early 2000s gave us Solvency II. Also with economic capital, solvency capital, like own risk solvency assessment and things like that. All of that is taking us to stress testing, right? And then the financial crisis of 2008 have demonstrated the stress testing as a point in time is not enough. You must have stress scenario through the cycle, understanding the consequences. Mm-hmm. What did COVID taught us from that perspective? The COVID taught us that it's not enough to have 1 or 2 or 3 stress scenarios. You need to have a lot more than that. You need to be able to generate thousands of the scenarios that include all of the shocks that Emma talked about with their probabilities, but also trying to capture consequences on this scenario. And then, unlike direct insurance approach, when you need to price as precisely as possible your risks, when you have so many scenarios, your objective is not precision. Your objective is to reach the outskirts, to reach the tail risk. And insurance industry, better than anybody else, understands tail risks, right? That's all what they're about. But what is often missing, people in, like, let's say, P&C insurance, quite often are focused on very low probability, high severity events, which is great. You must capture them, but that's not enough. Just because you know the risk of meteorite hitting the earth and what can happen there, right, doesn't mean that there are no much higher probability but lower severity events that in combination and their consequences can deliver as bad as it is. So we think what insurance industry really needs right now is first to have the full distribution of risk, comprehensive with all the tails that will address
really
asset and liability.
It really, I'll tell you why, because we're definitely going to tackle a little bit, how can we do this kind of so much more complex testing or kind of scenario generating. So definitely a thing to look about. And I want to address another thing that you talked about, which is that from each kind of, let's say, disaster that we had, throughout the years, we generate an interesting directive or regulation out of it. So I'm gonna kind of transit from here to Amit with a question that can actually relate. Now we understand that we always generate new directive according to different disastrous scenarios. So I'm going to take a step back. Okay, it's easy to forget that, like, but time like we have now, you are here to remind us, okay, that insurance is not a nice to have. Okay, this is essential for sustainability, essential for progress in social and business agendas. It's not a nice to have. It's really a must have. It's a growth enabler. So my question, there's kind of an inherent tension. Okay, the insurance companies are independent. They are profitable enterprise, and maybe some risk sometimes are simply too risky to insure. So this tension of being really an agent of, let's call it a social good, on the other hand, being a profitable. So how do you as a regulator kind of address this complexity, if you address this complexity? You're on mute, Amit.
Sorry, now it can be heard. So thank you for the question. I think, yeah, you touched a point that is probably pretty challenging and tricky for regulators all over the world. We're probably one of them that we're obviously experiencing this conflict or this challenge. And just as a remark, in Israel, we're not working with a structure of a Twin Peaks regulator. So we're considering the whole perspective. And of course, one of the main goals is ensuring insurance availability as a top goal for economic growth, but to have a good balance between fairness and transparency and making the policies bearable for the insurers and making them the risk insurable. So just with regards to what Ala and Emma just said, I think that in this context, we have to see a few phenomena and the environment we're living in. One thing which is very, maybe I'll frame it a bit differently, is I think we're living in a world of much more complex risks. If we were living in past years with traditional insurance products, which were property insurance and liability insurance, which were much more understandable relative to what we're knowing now, which are much more based on historical data and much more predictable, simple insurance product with less gap of expectation between the insured and the insurance company. Today, I think that the risks are getting much more complex. For example, cyber risks, and even when, as Ala referred to this pandemic, I think that even if we projected such a pandemic, we obviously could not predict how governments would react and how this would affect the real economy. And I think this is something that is inherent with the environment and the risks and what is being insured and much more data rich. So I think this is something that makes insurance much more a challenge, but makes it more challenging for an insurance company to take. But the regulator has to see the tension between the two. I think that another phenomenon that is has a very major impact on the environment of insurance is probably that the role of insurance and the understanding of insurance is being redefined. I think that insurance, by definition, the underwriting process is a process which is in a way discriminatory because it has to find who has different risks. But the expectation of the general public, maybe as a result of the flow of information and social media, makes it maybe a bigger issue why this or that is not insurable, and makes it maybe from the populist agenda as a risk that is expected to be insured. And insurance does not behave as statistically and as it has been traditionally. And I think relating to what Emma was saying, combining these two issues, I think that we're more and more having to model and to design products and to supervise on products which are not purely statistic, but maybe modeling the flock of black swans and the unpredictable, and this makes risks much more difficult to market. And I think us as a regulator, with any structure that we're looking, both Twin Peaks structure or any other structure, we have to find the right balance between making the insurance product affordable, understandable, and maybe finding the places which risks that are not insurable should have the support of government funds and to bridge these gaps, which are, from my estimation and understanding, are widening and becoming bigger.
Yeah, that's great. But by the way, I noticed also that I mentioned only one tension or complexity, to like insurance companies versus, not versus, but existent versus maybe let's call it the market or society. But you actually mentioned another one, which is insurance companies, and you have the kind of end user, which kind of a lot of its own expectation, and government, also the kind of political aspects of it, of the fact that you can't kind of predict how each government is going to deal with another complexity to add to the pile of scenarios, I'm sure, as we can clearly see, like in different countries in this pandemic. So,
Otni?
Mm-hmm.
Otni, this is Arjan. I have a question. It's I heard some very interesting things, for example, from Emma, describing, how you can define what is an insurable event, and that things that previously could not be defined as insurable can now be defined in such a way. Now, where I wanted to shine a light on was on technological advance. Yeah, we have had digital. We have been experiencing digital transformation and an acceleration in that. that brings along with it certain risks. For example, we have cyber attacks, and I really wanted to find out from the various participants, how do you predict risks related to cyber attacks, and how do you make it into something that can be insured?
Interesting. Anyone want to pick up on that? You're on mute, Emma.
Yeah, I think. Yeah, Emma, go ahead.
Thank you. We first of all, we don't try to predict. I think that's important, and we would be fooling ourselves if we did try to predict what was going to happen. What we are trying to do, and it's much harder with cyber than it is with some of the perils that I'm more accustomed with dealing with, is stay up to date with what the threats are, and it involves having a view of or having some sight of what's going on in the world and what the most what the most recent threats are, who the most recent sort of active potential participants are in causing cyber attacks, what the motivations are, and what the technologies are that are available to them to be used. And what we really have to do, or find a way to do, is make our management of cyber risk much more real time and much
maybe
more.
You want to address now the drill that you're made in Lloyd's. Maybe you want to have a few words about that.
Yeah, so we've developed a new set of cyber, what will effectively be RDSs, realistic disaster scenarios. But for the moment, we've launched them for the first time, and we're collecting data from the market as to what they think their losses could be from them. But our three key scenarios that we're looking at now are a blackout scenario where power distribution is knocked out for 36 states of the US. So that's a pretty systemic risk. Also a sort of cloud failure, a cloud cascade scenario, and a ransomware scenario. And they're built upon sort of historical things that have happened, and also threats that we see as current and have the potential to happen. And they're updates to scenarios that we've been looking at for the last 10 years. Unfortunately, we know that within 6 months they'll probably be out of date, and it won't be that thing that we need to worry about in particular. But at least by looking at something that seems a little bit like a worst case scenario, we can get a handle on what our potential, not worst case, but pretty close to worst case losses could be.
Somewhat reasonable worst case scenario.
Reasonable, yes, and also reasonable for us to capitalize for. As an insurance company, you can't hold capital for literally the worst case scenario, because that's just not economically viable. But you have to ensure that you will be solvent in the event of something pretty bad happening. Otherwise people like Amit will tell us we can't do it anymore.
Yeah.
So it's finding a balance.
Yeah, I said it's interesting because it's not a game of prediction; it's a game of probabilities, essentially.
Yeah. So. Yes.
I think this is very important. What you said and what Emma said, that this is the game of probabilities and what is feasible, what is plausible, and obviously catching a risk of one of these major catastrophes, right, from cyber attacks can actually cause a tremendous amount of smaller cyber attacks, which usually the probability of smaller cyber attacks on individual financial institutions is increasing in general chaos, right? And we saw that in COVID environment. And that's exactly what we're talking about, the consequences, right? Exactly. And with smaller cyber attacks, we have plenty of data to understand what kind of losses it can cause, legal risk, reputational risk, like that you will be able to write fewer premiums, if the information of your policyholders is stolen and things like that.
Yeah, absolutely. Arion, you throw a question at me, but I want to throw a question at you, so I won't let you get away. But the entire conversation was very high level, strategic, regulatory strategy. We took all that, but I want to tackle maybe the more tactical, real-time essence of disastrous scenarios. So maybe you can add something about that, and even add the importance of real-time, effective incident management.
Sure. Thank you. Yeah, so we are looking at things much more in a micro environment. So yeah, we have major incidents that you can take a critical part of a company down. In general, our focus is very much on at the IT level, though we can also work beyond that. And yeah, then very much what comes up when we're talking to an organization, we ask them, how do you in real time deal with a major incident? And then they will say, yeah, because you expect that they have sought out how they will do that. And well, then you get the answer, well, if a major application is down, we get everybody in a conference call, every hand on deck, and they're even proud. Yeah, everybody pitches in, everybody pulls in the same direction. But then when you dig deeper, you find out that, yeah, with the size of the team that they involve in that way, they slow down resolution. And yeah, this is a big problem. Yeah, you have people coming into your call and they need to be updated, and the people who really need to resolve it, they are slowed down. And yeah, when you have a major application for your payment not working, and people cannot order stuff and go to your competitor, yeah, that is a major incident for our customers. Yeah, they cannot afford delays. So yeah, that is the kind of scenarios that we are dealing with. And it's yeah, often when you look at what is going on, then you see that organizations are often not very well prepared in that. So that is in real-time major incident, but also, let's say, in security. Yeah, the organizations will have bought security software to address cyber attacks, but because it's not their core business, they have implemented it and they're not taking enough attention to further implement the software because the IT environment is developing further, or they will have adopted and implemented a disaster recovery software and they are never testing it. So now, of course, yeah, these kind of events, they are events that, yeah, if there's damage that organizations would like to insure themselves for. And well, when I bought my own home insurance, my insurance agent said, well, you can get a lower premium when you take certain measures in your home. So I did. And yeah, when you have organizations so rapidly digitally transforming their organizations, yeah, I'm interested in finding out to which extent the insurance industry is taking measures to stimulate organizations to mitigate against these major incidents. And I know,
by the way, I like
some of that is going on.
In relation to what you said, I did tackle, like in the research, you know, towards this event, I kind of tackle an interesting research that on two researchers that wanted to things from Oxford from the more than 25 years ago. Okay, but it's interesting. They try to assess the stock market value of companies after a catastrophe. And I'm quoting, okay, here's the quote. The research suggested that direct financial loss was a small part of the effect on shareholders' value. The skill with which a company's management responded has a much greater effect. This kind of relate directly to what you're just talking about.
Okay.
Interesting.
You're hired in our marketing.
Fair enough. We have only a couple of minutes left, so I'll just a question to Amit, okay, and see if we can kind of limit it to a 2 minutes answer, and maybe other will want to tackle the same question. It's a general question about international collaboration. So, tackling from the regulator side, very generally speaking, the UK regulator is quite keen on international collaboration. We have just mentioning yes, the GFIN Global Financial Innovation Network scheme headed by the FCA. So Amit, I'd love to hear your thoughts a little bit on global collaboration in the world of insurance regulations. If there's a value in it, is there no value maybe? How do you see it?
Of course, I think no doubt that we're living in an age of blurring borders and collaboration between industries within the insurance industry, between regulators, is something that is growing and is part of our global environment and ecosystem. In one aspect, I think that at least in terms of risk management, I think there is we're seeing a lot of convergence in practices and less the structure of islands that are not connected with each other. So I think the standards and the practices of supervision are pretty much converging. In this aspect, maybe we should also remember that insurance risks and the global economy is affecting the interconnectedness of risk. Data is pooled, and cyber attacks probably do not see any borders. Every regulator has to have their eyes also on the global economy and the global markets and other regulators' practices, even if regulatory arbitrage comes into place within countries that can have a very big effect. And of course, we have to remember that, referring to what I said before, on the evolving environment of insurance that is pretty much the understanding of it and the disruption that is changing the market, that also the provider of capital and who is taking the risks are the global reinsurance industry. And this industry and its stability and its practices and its risk appetite are also it's also narrowing, and its supervision, its oversight has to be seen globally. And this, of course, makes us as a regulator, but also the industry, have to be much more up to date and coherent with other regulations and other actions that regulators are doing.
Mm-hmm. Emma, can you maybe address also the same question from the angle of the industry of insurance itself, and maybe pour in a little bit of innovation and of technology, and which part does that take? So kind of put everything in the same pile and see if...
I think most of my answer
and take 2 minutes.
Most of my answer has been stolen already. That I agree with a lot that's been said already.
Yeah.
You know, what we're learning, what we've learned this year, and we're continuing to learn, is that risk isn't, you can't silo risk into geographical boundaries. It spreads across the world. So regulating one country at a time, or thinking that you're insuring one country at a time and you're not going to be impacted by something that happens elsewhere, is just crazy. Plus, to the point, you know, reinsurers are global, insurers are often global, everybody has exposure everywhere. And we now know that all of those exposures and all of those risks are interlinked.
Taking it globally is making it very, very much complex. So I would ask, like, how do you, obviously technology plays some part of this kind of RDS scenario. So I'd love to hear like a few words about that, and then kind of switch the question also to Ala to have her angle as well. So.
Technology is vital in order for us to understand this. You know, when we're modeling one complex thing and adding on top of it another complex thing, the amount of complexity you have is, you know, disproportionately increased. And we can only deal with this because we now have computers that can deal with it, and that can simulate millions of potential events and can simulate the potential impacts of those events and how they cascade.
So it's a numbers game. It's just
it is a numbers game, and the more that computers can do, the more we can understand when we get it out the end.
Quantum computing is on its way, so
True.
Fair enough. Ala, maybe you want to address it?
I would add to that you know, like, computer power is amazing, and what we see from, you know, like, advances in computer power is tremendous. Data is amazing, right? And the more data we have, the more we can address and analyze. But what is also very, very critical is the way how you process the data, the way how you use the computer power, the methodologies that are behind it, the methodologies that are used by machine learning, artificial intelligence, etc. They have to be explainable. Otherwise, you cannot make decisions based on that. Human component is still very, very important. And from that perspective, understanding the global exposures of risk must involve changing relationship between all of this available data. And technology by itself cannot capture this changing relationship. The methodologies should, and scenarios are one of the methodologies that can enable that, capturing all of the dynamic correlations and helping to integrate all of these technological advances into a comprehensive picture that you can analyze and make decisions.
Really understand. Aryan, do you want to add like another thought around the technology aspect?
I will try.
By the way, I'm addressing you because you kind of lay the tactical aspect here in this discussion, right? We're all about strategy, so you kind of bring the tactical. So
yeah, I'm
going to make it even give it kind of more accurate. How much of this real-time response based on technology versus methods or just being ready?
Yeah, it's definitely process that you need to enable. Yeah, it's what we find in an organization is that there is now plenty of technology in order to address major incidents, but you need to line up these these technologies in a proper way in order to get a benefit out of it. For example, you can handle a major incident by email. But yeah, if there are many people involved, you will have so many emails that you will lose the thread of what's going on.
It's also a numbers game a little bit.
Yeah, so there you need to find a process in order to effectively deploy these technologies and get the thread out of this, so that you can maintain the thread of what you're trying to resolve and to address. Yeah, in terms of regulation and cooperation, well, I have been at the receiving end, or with customers at the receiving end of regulations, and one thought that you should take into account is if you are a customer and you need to comply with so many regulations, then yeah, how do you handle that? And there is probably a good point to be made in order for more uniformity in how regulations are handled within an organization and how they are enforced by regulators, because otherwise it becomes very, very problematic, and that by itself creates risk.
Yeah. Great. So we are kind of getting closer to the kind of final round of question. Addressing the audience, if you have questions that you wish to ask one of the panelists, so now's the time. We have a few minutes left. I will, while the audience is typing question, maybe, I'll address a quick last round of question, kind of more of a lightweight thing, which is maybe not appropriate for a catastrophe scenario thing, but I'll try anyway. Looking 5 years ahead, this is, I'm going to, all of you, I'll be happy to hear your answers. Looking 5 years ahead, which insurance aspect, okay, could be from any kind of insurance, from the client side, from reinsurance, from insurance, anything that comes to mind, which one do you think will be significantly impacted or changed, hopefully for the better, as a result of current times? So anyone want to pick up first? Ala, maybe you can start.
Yeah, I can start. Well, from my perspective, I think that with all of these advances that we have right now, these technologies are very much siloed. There is a great technology that helps you with claims. There is a great technology that helps you with marketing. There is a great technology that helps you with risk management. But what is really needed is integration of these technologies. So this risk management becomes much more dynamic. Cyber attack happens somewhere in the world. The models that calibrate the risk of cyber attack immediately get upgraded. So in 5 years, I think that all of these technologies will be integrated into one big platform where you can address both real-time decisions as well as strategic ones.
Yeah. So we'll have Aryon orchestrate everything. Amit, maybe you want to address that as well?
Yeah, I think that from my perspective, what I'm taking from the current crisis and probably from recent years, that there would have to be much more engagement between all parties within the insurance value chain, starting from the insured, understanding the risks through the policy, the insurance company, and the regulator. Just as a small example, of course, that 50 or 100 years ago, there were barely any smoke detectors, and now it seems like something that is obvious when insuring for a fire policy. So I think today it's much more data-driven and much more complicated to understand, and it is much less trivial. But this is the core and the essence of the road that the insurance industry will have to go through.
Interesting. Thank you. Aryon?
Yeah, so related to the smoke detector, so I think that over time, insurance companies will more and more have to look what the IT and security posture of organizations is, in order to make sure whether what kind of risks these organizations present. So I think that therefore, yeah, the insurance organization will much more get into to assessing what is going on, and will get deeper into the IT environment that organizations have.
Good thing. Emma?
I think Aryon's completely correct, and I think that in 5 years' time we will have done a lot towards that. At the moment, insurance, at the moment our understanding of cyber risk is at a level where it wouldn't necessarily help us if we did know all of those details about every single company, because we're not yet ready to handle that volume of data and to process it and analyze it and use it to make decisions. But within 5 years, I think we will be collecting that sort of information. We will be getting that information, and we will be using it in our decision making. Just as a comparator, 10 years ago, we weren't asking every Florida homeowner what material their roof was made of before we decided how much to charge them for their hurricane risk, whereas now we collect that routinely and it's used in decision making. So that will definitely, I'm pretty sure that will happen. My original answer to this question was going to be much more along the lines of the previous two, which is all about the interconnectivity. And I think something the thing that we're learning right now is that everything is interconnected, and all the different types of risk we have are interconnected. And we're looking at insurance risk, we're looking at insurance risk and how things can impact insurance risk and also impact reserving risk, and also, to Amit's point, impact assets and impact the balance sheet. And we can't any longer assume that insurance is a risk that's not correlated with investment risk, because they can, they can both go wrong at the same time.
Absolutely, absolutely. Especially
so
the
hopefully we'll
structure
find
of
a way to
insurance
address
companies
that.
is also kind of related to this exactly.
Yeah.
It is interesting, by the way, that the answers of Ala and Amit are kind of more of the integration, interconnectivity going kind of bigger and bigger, and Arion and you and Emma answers more of kind of going to more specific, more detailed, kind of smaller and smaller, which is interesting. Susie, do we have any questions?
I think, let's say, you've addressed probably all of the current doubts and questions that the audience has.
Speechless, yeah. Completely knocked them off there.
but no, I think like the conversation and the discussion was really great, and it took the conversation into different directions and from very different levels. So I think it's now our time is up, but I would like to really thank everybody who attended the webinar and the panelists. You were really amazing to listen to, and we will be circulating a registration of the webinar and the contact details of me and Otni for whoever would like to be in touch. And thank you, everybody, and enjoy.
Thank you, Susie, for putting it all together. You did an amazing job. Thank you so much.
I agree. Thank you very much.
And
thank you for having us.
This initial conversation will stir and more other conversation to come. Thank you again.
Thank you.
Have a
Thank
great
you.
day. Bye.
Thank you.
Bye-bye.
Bye-bye.